I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been in business for more than 55 years, delivering advice to individual investors. Brad, lots to get to today. The market is a busy time in the market. Things are a little brighter now than they were a week ago, especially, definitely better than they were 2 weeks ago. So we'll dispense with the usual banter at the top, and you can just tell people what we're going to talk about today.
Obviously, got to talk about the market rebound of the last week. We are also going to talk about the temperature coming down on President Trump's threats against Jerome Powell. There are some interesting developments in the EV and autonomous vehicle space. We are going to talk about earnings. Earnings season is underway, and there are some really bright signs in there. There's bright spots, I guess, is what I'm looking for. And then we're going to talk about Netflix. They seem to be one of the big winners in on Wall Street right now.
But first, as always, is we're going to talk defend the take, or we're going to have our defend the take. And this week, Brad, you're up. It's a take for which you have 96 seconds to defend. And your take this week is that the market's green light is above the 50-day line. Again, you have 90 seconds. Go.
All right. So obviously we are coming off a period of really extreme underperformance. Intraday we were in a bear market on the S&P, but we never closed there. NASDAQ and the Russell both closed there. So I'm of sort of two minds as what's the trigger to buy back in. The value trigger, like if you're looking at fundamentals, if you're looking at sort of classic PE ratios, the value trigger is actually a lot lower. For us to get like the Buffett indicator and Schiller PE and getting all those numbers back to sort of a more reasonable, let's say pre-2008 level, 16 times earnings or whatever. That we have a way to go for that to be the case. But for a momentum investor or for somebody that has been trading maybe more recently or is giving more weight to more recent market characteristics, I do think that the green light to start buying in is above the 50-day line for the NASDAQ and the S&P. The mood around here right now is cautiously optimistic. Both Jacob Mintz and Mike Santolo have said as much. I think that'll emerge in this episode as well. But if we look at it from a technical standpoint, the two numbers that stand out for me, 5,500 on the S&P, we're sort of banging our head against that resistance level right now. But it's actually really a range of resistance going all the way up to like 5,600. That would be closing the gap from Liberation Day on the S&P. The NASDAQ is
I'm
more like 72.5, 75 or 17.5. 50-day is a good shorthand for all the overhead resistance we have to get through.
okay. Just a little past the post there, but that's all right. Yeah, just to provide some context. I mean, I think you could buy even, uh, now, but uh, above the 50-day line does seem like a safer, if there's such a thing, green light. Mike Santola wrote today, 70%, more than 70% of stocks are still below their 50 and 200-day lines, as is the market itself or S&P itself. But there's a key blast off, what Mike calls a blast off indicator. You have several of these that are, uncanny in their accuracy. Um, something that rarely flashes, but almost always leads to great results 6 to 12 months down the road. So one called called the 3-day thrust, but I think is similar to the what's it called, the Martin Zweig breadth thrust,
Yeah.
that just flashed. When the S&P rallies at least 1.5% in three straight sessions, um, it has the market up 20% plus a year later. Um, and most signals occurred either at great takeoff points or during bottoming processes after tough bear phases. Um, so, as Mike says, it doesn't mean there won't be some wobbles in the near future here, but this was a productive week, that's for sure. It seems like we're, as Mike says, similar to you, that his indicators are still pointed downward,
Yeah.
at least in the big picture, but we're getting closer to, the arrow pointing up.
Yeah, I think we've talked about it a little bit ahead of this. Like you can start taking flyers
Yeah.
on stocks that, especially stocks that are responding well to earnings, which we'll get to a little bit later.
Your
But
earnings season will be the next big catalyst thing is I don't know if it's coincidental, but uh it's if it's just still all about tariffs, but it seems like earnings season are at least not hurting the market right now. But anyway, sorry, go ahead.
yeah, so that point is well taken. Part of the difficulty is the environment remains really uncertain because tariffs at China are maybe they're coming down to 65% from 145 or 245 or whatever number they're at. We may get a re-implementation of reciprocal tariffs in the next couple of weeks if people aren't coming to the table. Um, that uncertainty isn't necessarily going to clear, right? President Trump blinking on the mass tariffs was enough to sort of stem the bleeding and end the panic selling.
Yeah,
Um, but it's not enough to restore full trust in whatever the economic plan is going forward and to get people really in a bullish mindset. I think that's going to take a little bit more time. I do think that just from a technical standpoint, if I'm on the fence, if I maybe went to cash, because the important thing to also keep in mind is the bear market that we are in or coming out of, it didn't start with tariffs and Liberation Day. It started in mid-February. It started
yeah,
coming off of like overheated valuations and maybe some fear of uncertainty.
yeah,
So we're out of the panic phase for the time being, and but we are still back into that sort of steady selling from mid-February that we were seeing even before the announcement of tariffs. And if that is the prevailing trend, or if that remains the prevailing trend, then we would probably expect it to top out somewhere around where it is now. It's 11:30 Eastern time on Friday. Right now, we're just sort of pinned under what I would look at as resistance levels, but there's also a lot to chew through. So,
yeah,
I mean, last point on this, um, in the 2022 bear market, we did get up and over the 50-day line in the midst of the bear market. So it reversed course and then came back and hit lower lows. I do think that we can discount that a little bit just because the panic selling this time was so extreme. I think that brought values down a lot faster. So I think there's less risk of a head fake if we get above it. If I'm looking, I'm not necessarily saying pile in, go from 0% invested to 100% invested once we clear the 50-day line, but that's my trigger to if I'm extra conservative, which I tend to be, that is one of my triggers that I'm looking at to be like, all right, well, we're going to start 15-20% reallocating into stocks where maybe if maybe we had been in cash.
yeah. I mean, S&P is up 10% from the April 8th closing bottom. I mean, that's
Yeah.
certainly not nothing. Seems like there is some resistance right around here in the 54, upper 5400s range S&P. That's where your 50-day line case makes a lot of sense because if breaking above resistance would mean breaking above the 50-day line.
Yeah,
Um,
that's exactly it. I could have
yeah,
done my 90-second defend the take could have been that one sentence.
yeah, no, it's fine. But I think you can confidently say that a bottom has been put in, barring some like, horrible tariff news, which is not,
Well,
uh, you, you can't feel fully safe from that in this environment.
yeah. That's the difficulty
But
because news trumps technicals. If
right.
some unknown comes out and whacks the market, there's no way to price that in, and there's no way
Right.
to assume that that's effectively been priced in either. So the headlines are always going to trump the technicals. But if we continue sort of on the path that we're on now, I think technicals become more supportive once
Yeah.
we're back over the 50-day.
Let's move to some of the reason this week, at least, why the market rebounded. Trump had been very critical of Jerome Powell, saying I think last week, he said his termination cannot come fast enough. And then what do you call him, a loser or something?
Too
And then
too
this week,
late.
What's that?
He called him Too Late Powell or
Too
Mr.
late.
Too Late.
Yep. Then this week he says clearly sensing that the market did not like the specter of him removing Powell. The criticism of Powell because that just leads to further chaos. At a time when we need, the Fed to sort of thread the needle the way they have been the last last year at least. Uh, he said he has no intention of firing him to the degree that he's able to do that anyway, and the market loved that. He also talked about, hinted at possible negotiations to lower tariffs with China. There's no solid news on that yet, so there could be just lip service. I think it shows what I've said on here is that because this is a self-induced market sell-off, really. Unforced error, all the tariff stuff, totally avoidable. That the good part of that is that it can undo it, at least to a certain degree. And I think Trump's own interest in the market doing well on his watch is one thing that might be acting as sort of a floor here. As stocks were sort of seemingly going back towards the that low from earlier in the month, he came out with the no intention of firing Powell. And he can always backtrack on that, which I expect him to at some point, especially if they don't lower rates next month. But it at least shows that I think it shows that Trump is paying attention to what the market likes and doesn't like, and market clearly hates, the possibility of Powell being removed. So that's offered sort of a life raft for the moment.
Yeah, 100%. Also, sort of hand in hand with that, there was reporting that Walmart, Home Depot, and another retailer, I don't remember whose CEO, basically were in the White House saying, "Hey, if these tariff rates keep, stay where they are, we're going to be looking at empty store shelves, you know, 3, 6 months down the road." And that
Yep.
that may have been some of the impetus for at least giving the impression that there's more of an agreement with China. Um, the Chinese Communist Party has come out and said that no, they haven't spoken to President Trump, but we have, we've acknowledged before that you really cannot take a lot of their official communications purely at face value.
Hmm.
Unfortunately, I think that's also true for President Trump. Um, so until we see something in writing, until we see something more concrete, we're just stuck taking this stuff on faith. But yeah, there is definitely an improved perception that the market's reaction is, or if not the market's reaction, at least sort of vested interests in the market's reaction are increasingly a motivator for the White House.
Yeah.
I don't know how much weight that'll carry because if that carried weight going into tariff negotiations, you would have thought that the tariff rollout would have been handled differently from the start. So I'm a little bit hesitant to say, well, it matters now, but it didn't matter before they were rolled out. But
Yeah.
the bomb throwing and the volatility and the art of the deal, as it were, chaos is sort of a tool.
Yeah.
So, you know, I can't you can't write off entirely what is being said, and you can't necessarily assume that the motivations are always constant. And I think that's part of the game that he is
Yeah.
playing. So it's tough.
Yeah, a couple good things in terms if you just look at market evidence, a couple good developments. Volatility of the VIX has dipped to 25, which, still high historically, but down from almost 60 at the
Yep.
beginning of the month. So that's good. And the number of new 52-week highs on the New York Stock Exchange and the NASDAQ now slightly outnumbers the number of new 52-week lows, which it was complete opposite of that. I think we reached over 1,000, well over 1,000 new 52-week lows at the bottom, just two less than 3 weeks ago. And that as Cliff Droke, chief analyst Cabot turnaround letter had noted, then that's historically a very um, bullish. Maybe bullish isn't the right word, but um, contrarian buy signal. So far it's turned out that way.
Yeah.
So sort of just the under the surface stuff flipping um, sort of points towards, things headed in the right direction here. Do we want to move on from Fed tariffs and market and talk about more fun stuff?
Um, yeah.
Or any last points?
I no, I do think that the sort of contrarian indicators, the extreme oversold stuff is definitely relevant. Mike Santolo is historically does not make predictions, just goes with evidence in front of him.
Yeah.
And the one thing he was writing a lot in the last month or so has been a workable bottom, but not necessarily the bottom. And I think that's sort of good advice to take to heart. Um, because there are so many variables that are still out there. So yeah, it looks like the worst of the selling is probably over for now. Does that mean that we can't go lower? No. But even if like what's the worst case scenario? Tariffs go back to exactly where they were 3 weeks ago.
Right.
Okay, well that we already saw the reaction to that 3 weeks ago.
Yeah.
There are other things that can sort of break or weaken, but the panic period seems to be mostly over. But whether we're heading higher or heading lower from here is still an open question in my mind.
Yeah. Okay, let's move on to number three in our starting five. Autonomous driving, which has been mostly a theoretical thing, um, got a boost from the Department of Transportation, streamlining auto vehicle regulations, which has been good for Tesla today. Tesla's up 6-7%. And then another sort of breakthrough in the auto industry, Stellantis and Ford had sort of battery breakthroughs. You did some a deep dive on this. I'll let you cook for a couple minutes.
Yeah, so Tesla's up 8% right now.
8%.
Yeah, intraday they're up 8%. They are rallying big on the news. The Department of Transportation came out and they offered some clarification on their existing framework for handling autonomous driving. Um, they specifically noted that it's going to streamline the reporting process and it's going to simplify that. This is the kind of deregulation that I think a lot of people that were optimistic about President Trump's first term were looking for, which is let's make it easier for businesses to not only innovate, but also to do business. So streamlining reporting on crash incidents was one of the three pillars. The other pillars that they included were adding exemptions for domestic vehicles. So they had exemptions in place for imported autonomous driving vehicles. And then there's also a push to enable commercial deployment. The thinking there, obviously, being that we could have trucks in the next couple of years, like semis, just hauling across American freeways with no driver in them or possibly remote operators for whenever it needs intervention. Um,
Yep.
this is why people were buying Tesla, this sort of
Right.
development. And like, obviously, I know Musk has had it, and when they reported earnings, he mentioned difficulties, I think, in sourcing robo-taxi components from China because of tariffs. But if that can sort of get sorted, this does lay the groundwork for some of those pie in the sky plans. Um, it's not a final resolution for the question. It's going to lead to like National Highway Traffic Safety Board rules and some other regulatory rules, but it I guess you think of it like the Green New Deal, right? Where Biden's coming out and saying, "Hey, we're gonna build out this EV charging infrastructure." We're outlining just the big picture goal, and then we'll work out the specific details later. Uh, this is great news for Tesla.
Yeah.
Um, there was another two other developments that both have come out in the last 2 days on the EV front. Stellantis, which makes Chrysler, Jeep, Dodge, Ram. Um, Actually, they might have sold off the Ram assets. I don't know. They make Chrysler. They announced that they've got developments with their solid state battery technology. Um, so they are working with Foundry. I think it was called Foundry or no, I'm sorry, no, Factorial Energy. They validated their solid state battery cells. And then today, Ford said that they've had a breakthrough with lithium manganese batteries, and they expect to roll out within this decade. So those are the kinds of batteries that are going to get you fast charge times and longer distances. I don't think that like Ford already loses $100,000 per EV. I don't think these are game changers for the domestic automakers. I think the big winner from the last couple of days of EV development, AV development is Tesla. This is just getting back to the bull case um, from I don't know, before 2025, really.
Yeah, the Stellantis Ford battery thing doesn't do much for me, but the Tesla thing, this is why a few weeks ago, when things were really looking pretty dire for Tesla, and we're going to get to earnings in a second. The earnings were not good just this week, so the timing of this maybe makes some sense. Trump doing his cabinet member, at least for now, a solid with this whole deregulation thing on autonomous driving. But this is why I've kept Tesla in the my stock of the week portfolio. It's been in there, since December 2011. So to get rid of it would be getting rid of one of the greatest stocks in the history of Cabot Wealth Network. But I've said, let's hang in there because the reasons it shot up after the election and subsequent, you know, promotion of Musk to head up Doge, the reasons behind the stock shooting up then are still in place now. He's still there, even though Musk has said he's going to back off and focus on Tesla. But just the fact that he's been a good soldier for Trump the first few months, I think lends itself to Trump doing things like this, sort of throwing him a bone at a time when Tesla really needs it. Um, and I think that's the reason to keep, if you own Tesla, to keep hanging on to it days like today.
Yeah. Yeah, it is still very much a let your winner run. Just from a bigger picture standpoint, the big I think the biggest issue preventing widespread autonomous vehicle driving is, it's not specifically safety, right? People are injured in auto vehicle accidents all the time. I
Yeah.
think it's really a question of liability. There is a reason that Tesla reverts to manual control from full self-drive before any sort of incident.
Yeah.
There's a reason that Ford has like a hey, you got to have your hands on the wheel at all times. You need to be paying attention, and that's because there's really no legal framework for where liability lands with
Yeah.
autonomous driving. This is sort of a step in that direction,
Yeah.
right? You get some regulatory clarity on who owns responsibility for collision. Maybe I don't know if you can legislate like damage caps or liability apportionment in a meaningful way. But there have been a lot of open questions around what happens if we roll out widespread autonomous driving. And this is it's another step towards sort of solving that problem, which allows automakers to be more innovative or take bigger risks, at least.
Yeah.
Obviously, the risk is you're forcing risk on other motorists on the roadway. So there's still a degree of responsibility, but this is kind of an impossible question. Like, okay, if I'm driving an autonomous vehicle and there's a garbage truck pulled over on the side of the road, and now I'm going head to head with somebody, where does it steer me? Does it steer me onto the sidewalk, into the path of a pedestrian? Does it steer me head on into an oncoming vehicle, or does it steer me into the parked garbage truck where it's like, okay, well, the real damage will be to the EV owner and driver, right? Like, how does it prioritize that kind of stuff? For as long as those are open questions, there is a big overhang of potential liability risk, and this helps clear, or this I guess builds a path towards clearing those questions up and will presumably allow for a lot more rollout. I do have a sneaking suspicion that Ford will roll out some autonomous vehicle driving. I think they probably have the technology. Well, I know they have the technology to do some of it. I don't know exactly how much, but I wouldn't be surprised if with some of these developments, you get surprise announcements from some of the other major automakers. But Tesla's got the data. Tesla is sort of best positioned to take advantage of this.
Yeah, speaking of Tesla, I mentioned let's move to some notable earnings results from this past week. Tesla reported wasn't good. EPS came in at 27 cents versus 41 cents expected. That's 35% shortfall. You know, the stock didn't implode after that, and actually it's now up. We're up 9% on the day now. So it's weirdly it seems like maybe the some of this selling was priced in. The earnings bad quarter was sort of priced in. So that was definitely not great, a not great result. But on the other side of the ledger, Google just came out with good earnings today. Tesla rival BYD came out with strong earnings today. Earnings overall are up more than 7%. Still early in the season, but up more than 7%, which is about what it was expected. Uh, we've seen mixed results with guidance. We talked about this last week, but guidance has been a little more mixed than the actual Q1 earnings results, which sort of speaks to all this tariff stuff has happened or most of it has happened in the second quarter. So we might not see actual impact on earnings until after this quarter. Next earnings season could be a lot more telling in terms of the hard data, which is what the Fed goes by, which is important. Um, corporate earnings are still holding up pretty well, at least, early in the earnings season.
Yeah, it does get along the lines of something that we had talked about, with one notable exception that I think we'll get to.
Yes.
Of There's been a lot of front loading of purchases. So durable goods orders were really, really high in March. I think they were up like 9.8% or something like that. I should have these numbers before I just throw them out. But durable goods orders were high from people front loading the tariffs. But then on the earnings front, it's been sort of a mixed bag. Pepsi lowered their guidance. I did not know this, but they import all of their soda syrup from Ireland. So they are going to take, even if only the 10% tariffs remain, they're going to take an immediate hit based on their expenditures. Hasbro, the toy manufacturer, they missed on earnings, $1 a share on 887 million in revenue versus was what was expected, I think. Or sorry, I'm gonna have to get these numbers. They didn't change their guidance, but they missed on earnings. Um, let's see, Procter and Gamble cut their guidance, so some of the rubber meets the road economy numbers are coming in a
Yeah.
little bit weaker. People, right? The earnings are pricing in some of the hesitancy that consumers have had. The big exception has been software, especially like enterprise software. ServiceNow reported 404 in earnings on 3.1 billion in revenue versus 383 on 3.08 billion expected. They were up 15% on the day. Google has had a really good earnings report, 281 a share on 34 billion in revenue against $1.89 and 23.6 billion in revenue in the year ago quarter. And an analyst from Macquarie basically positioned software as a haven for now.
Yep.
Um, they're a little bit suspect of whether these Q1 results are going to carry forward. Obviously, you've got some of the business front loading stuff, but then also a lot of these planned expenditures were probably planned at the end of 2024 when we were in a much more bullish spot. These are not deals that you ink overnight. These are deals that you build towards over months or in some cases even years. But for the time being, software has really stood out. I know Jacob Mintz highlighted software as a group to his subscribers a couple of days ago.
Yeah. And coming on the heels of last week, the bank earnings were strong. So, there are sectors where, the again, the sort of hard data results are working. Um, and so far, earnings season has done no harm. Even if there have been some earnings blow ups, which there always are. But yeah, I think your thesis of earnings season, being the next potential catalyst, I do think it's as the market improves, easing of the tariffs and the sort of tariff rhetoric is sort of the real catalyst. But as the market improves, people could start to use earnings as an excuse for buying, you know,
Yeah.
and we may be getting closer to that point where earnings are sort of more in focus. Like, hey, earnings are up 7, 8%. Time to buy. It's not doing any damage. Tariffs aren't doing any damage to the economy yet. So, the more strong reports we get in, the closer we might get to that point where it's a true act. This earnings season acts as a true catalyst.
Yeah.
Yeah.
Yeah, it's the addition of clarity. Um,
Yeah.
so sorry, I'm still looking for the Hasbro figures that I had. Indicated they may expect as much as like 300 million in impacts from Chinese tariffs if they don't come through. So
Yeah.
these are these companies are low on the food chain. They are immediately going to feel, or companies like this where their direct input is for the most part raw goods or maybe one step above raw goods. They're low on the food chain. They're going to feel the hit of tariffs first. Software high on the feed chain, or on the food chain. They don't have any physical inputs.
Yeah.
So, or they have very limited physical inputs. So they're going to be more resilient. Um, and then I think earnings will add some clarity to where that is settling out. So how high up that food chain does the impact of some of these tariffs go?
Yeah.
But yeah, there's definitely a case for outliers right now.
Speaking of earnings winners and companies, multinational companies that are not really hurt by tariffs, at least thus far, Netflix, our last topic here, is now hitting new all-time highs. In large part because it reported another very strong quarter. Uh, people aren't going to stop watching their shows or you know streaming content where Netflix is the dominant force due to tariffs. Maybe if the economy, if we do get into a recession, especially global recession, and people start cutting back, especially like sort of the higher price subscribers here, that could impact Netflix. But for now, this seems like one of the more tariff-proof multinational mega cap stocks right now, and Netflix is having a really good year. It's sort of flown in the face of what's happening with other, mega caps of its size, mega cap tech stocks of its size. It's up, let's see, now more than 9% year to date, over 90%, 90, excuse me, no, it's up over 23% year to date and up 94% in the last year. Compare that to like the Mag 7, which are mostly down. Yeah, is Netflix the new? I don't think it'll have the same kind of influence that Nvidia had, a year ago, less than a year ago, the market, but is it sort of the most reliable mega cap in sort of this tariff environment?
I think it's a definite winner. I
Yeah.
want to get into that. I got to put this Hasbro thing to bed. All right. Hasbro earned 887 million. There's $1.04 a share. Expectations 67 cents a share, 771 million. But they didn't change their guidance, but they said they could have as much as 300 million in impact from Chinese tariffs. So better than expected, but they're sort of cautious. Back to Netflix, now that that's been put to rest.
Yep.
Um, yeah, so Netflix, one of the things that came out that was really eye-catching, they announced that they wanted to be $1 trillion company. So they're at a market cap right now of about 466 billion. That means doubling from here, and they positioned it as a longer term goal. I don't think they're not saying they're gonna be $1 trillion company overnight, but as a longer term goal, they did. Their earnings were up 25% year over year.
Came
Revenues
in
were up
almost a
12.
full dollar ahead of EPS estimates, 661 versus $5.66. Pretty strong.
Yeah, absolutely. And revenues were up 12.5% to 10.5 billion in the quarter. Um, they expect their ad revenues to double this year. They doubled last year. There's no hard and fast numbers, but estimates are around 2 billion in ad revenue this year. The question that I have for us to sort of talk through. Can Netflix do it? Can Netflix become a $1 trillion company? Can the share price double in, let's say, like the next 5 years is probably what they would be
Hmm.
extrapolating out when they say it's a longer run goal. Um, because right now they make about $200 a household annually for their paid tier. Their ad tier makes $70 a year, and they expect that's actually going to decline to about $60 a year by 2026.
Hmm.
Um, they're in 90 million US households already, and they have 301 million worldwide subscribers, which they say is about 700 million individuals. So there's a lot of room for growth for them. They in the latest Nielsen report that I saw, um, it was mid 2024, 8.4% of total TV viewership belongs to Netflix, but they're not even the biggest streamer. I mean, they're the biggest streaming service, but YouTube gets 9.9%
Right.
of all TV viewing. And their leadership in their earnings call was quick to come out and say, our goal is to take more of that 80% of the people that aren't watching either YouTube or Netflix. I don't think they look at YouTube as a pure competitor because it's not scripted content, it's user created content. But they want some of that 80% that is not already watching YouTube and that's not already watching Netflix. Um,
Yeah, it's sort of Netflix is sort of becoming like, you know, Coca-Cola is in the soda industry where, in some parts of the country where I grew up in Virginia, you say I'm going to get a Coke. It doesn't necessarily mean you're getting a Coke. You could be getting any
yeah,
soda, but Coke is shorthand for I'm getting a soda. Or Netflix has become such a brand name and so ingrained and or intertwined with just streaming in general that, Netflix, when people want to open up streaming, say like, like my 102-year-old grandmother. If she were to ever, I don't think it's happening at this point. I think the ship has sailed. But if she were ever to adopt streaming, or people you know, uh, who have been resistant to streaming up until this point, like my grandmother, suddenly decide they're going to do it. Netflix is the name that they've heard of, the only name they'd know is sort of the safest one to go to. That would be the default, and that's where that opens up. Where you're talking about not so much in the U.S. but globally, where there's still a huge market out there for them. Can it double the stock double? Can they get to $1 trillion company next 5 years or whatever? Stock's up 150, a little over 150% the last five, so that would be um, it would have to nearly replicate that or not quite replicate that. Um, that's realistic. I don't think it's going to happen in the next couple years, but 5+ years, sure.
yeah. The tough thing that I keep circling around earnings. They're elevated at 50 times trailing earnings, um, but they are expecting, I think, an earnings growth rate of close to 30% a year.
Hmm.
They projected out for at least the next couple of years. I do think that Netflix has become the default streamer, as you put it,
Yeah.
right? Which gives them a leg up if consumers start cutting back on anything, or frankly, if people get tired of trying to navigate 15 streamers at a time. Like, all right, well, we have, Paramount Plus and Disney and Netflix. It's like, okay, well, I have Crunchyroll that I got for the show my kids watch. Like,
Yeah.
if I'm going to start trimming stuff to improve my budget, I'm not starting at Netflix. I'm starting
Right.
with Paramount Plus, where it's like, all right, well, yeah, I watched a few shows on this, but Yellow Jackets is over for the season, so I'm just going to cut it. Um,
Yeah. Paramount Plus, Hulu, Peacock, maybe even Apple,
yeah,
Apple TV Plus. Those would be the ones that would fall by the wayside. Where yeah, Netflix is I think where it's sort of sheer amount of content. It's just a geyser of content. It has the quantity over quality approach. I mean, there is quality, but there's just sort of a something for everyone there. Whereas Apple is a bit more niche. Same with, say, Paramount Plus or Peacock. Yeah, where people as costs rise among all streamers, people were to start saying like, all right, I need to cut back on this. They would start with the ones that they don't use as much, and Netflix would be sort of the last rung on the totem pole there that people would get rid of. To your point,
Yeah, I think Apple maybe gets a little bit of a moat because the Apple ecosystem is so intertwined. It's like,
yeah,
yeah, we have Apple TV, but it's also because we have Apple News and Apple,
yeah.
like all these other Apple services.
It would
Um,
be more the Peacocks, the Hulus, the
right.
Paramount Pluses,
And
was like Acorn and some of those. Yeah, there's a lot
I
of
think
them.
Acorn is a money-saving app. I don't know.
No, I think there's a streamer. Hold on, let me look at you. Keep going. Look at
Yeah, you look it up. All right, so one
Yeah,
of the things that Netflix sort of has going for it is all right, if I'm budget conscious, I'm going to cancel movie night for the family, right, going out to the theater, right? Because that's going to cost me $60 for tickets and then $40 for food. And if we're eating dinner there because they have a cafe, it's another $70 for food, right? It's $100 night out or $150 night out. Netflix is $20 a month.
yep,
I do think that they are in a position where they are like a lot of the streamers, they're nudging up pricing and they're getting to a point where they're trying to find that line at which people that are already premium subscribers are going to pull back and they're going to start moving to the ad-supported tier. Um, they have a lot of flexibility to move that line. So if they push up to $29 a month and they find that people start cutting, they can come out and say, okay, well, we're going to put it back to 22.
yeah.
Their margins are solid. I think they're projecting 30% margins for the next few years. They've got some wiggle room there. Um, that would be, I think, the biggest risk to Netflix is they're pretty tapped out on U.S. households.
Yeah.
There's outliers, but they've been around for decade. Like I don't know how long their streaming arm has been out, but the Netflix service we had 17 years ago, 18 years ago, we were getting the Netflix DVD
Yeah.
rentals by mail. So Netflix has been around a long time. Streaming has probably been around for a decade plus.
It,
Um,
it technically launched January 2007, but I don't think anyone was using it at that point.
yeah,
Uh,
okay. So it's almost 20 years. It's 18 years at this point.
yeah.
They're pretty saturated. They've got room to expand globally. Their own numbers, 300 million subscribers, 700 million individuals watch Netflix. That's 10% of the close to 10% of the population. I think the big risk to them is as it's a double-edged sword as advertising in streaming is increasingly normalized because everybody is now doing an ad-supported tier.
Yeah.
At what point do you as a consumer say, well, why am I paying $26 a month or $22 a month? Why shouldn't I just pay $8 a month for the ad-supported tier?
Right.
And that drops their revenue per annual user from, as I'd said earlier, close to 200 a year down to closer to 70 or maybe even $60 a year. So there's a little bit of a hit there. Um, I'm I'm hesitant to say that I think that Netflix can go to 2000 a share. I think it would take a lot of speculation around it. They would
Yeah.
have to have some path to even higher monetization or other revenue streams. Um, I don't know what those necessarily look like, where they can
Yeah, I'm hesitant to say that too, but I
live.
do think will it be a steady outperformer? Maybe not in the Nvidia over the last 2 years kind of a outperformer, but steady outperformer in the way Apple was, a few years ago. Um, I do think that. By the way, I looked at Acorn TV is a real thing. It's
Ah,
British, Canadian, and Australian content. $7.99 a month. My in-laws had it, so I knew it wasn't crazy. But
the live sports. That is, I think, maybe
yeah,
where Netflix can get some more juice. If they were to come out and say, "Hey, if you want live sports, you have to pay for the premium tier, no ad-supported tier for that," something like that could be a value differentiator for them. Um, there's certainly a path for it, but it seems like it's going to be tougher for them to sustain this kind of growth rate, especially when their growth rate's not going to be driven by like high value markets like the US and Europe and parts of Asia. It's where the 700 million people that are already watching Netflix are doing so in the highest value areas. So the opportunity is probably to expand to South America, Africa, other parts of Asia where they can't sustain a $23 US a month viewing habit. That's just not feasible.
Right.
Uh,
Yeah, the
oh,
the money they bring in per subscriber in certain places overseas is not what they bring in here, but that's where the opportunity lies. Um, okay, one last thing before we get out of here. I want to say one last time because we're nearing the end of April. We have our Cabot Wealth Summit called Investing Masterminds this August 13th through 15th in Cabot headquarters, Salem, Massachusetts. It's a 3-day conference. We hear from all of our analysts, all of whom have appeared on this podcast, and it include both Brad and I. I think we're actually doing a live episode or two of Street Check during the conference, but we are still offering our early bird prices. If you go to cabotwealth.com/street, we are offering them just through the end of this month, April 30th. You save $800 off the normal registration price. So if you go and sign up again, cabotwealth.com/street between now and the end of the month, you save yourself $800. I highly recommend it. It's a great time. We used to have it annually pre-COVID. Then we had it online a couple times during COVID, which wasn't as much fun. And now we're bringing it back in person. And it's Salem's a beautiful historic town. It's a great week, a chance to carouse with fellow investors, individual investors like yourself, and to again. I hear from meet and hear from all of Cabot's analysts. So again, cabotwealth.com/street. I think that's a podcast. What do you think?
I think I have one last thing that I
Okay.
meant to bring up. I apologize. My notes are like a Joycean stream of thought right now, so it's not super rigid.
Nice.
Tesla, autonomous driving. If you get the right regulatory framework, they can build a sort of self-driving rent a Tesla through an app update, right? Like they could roll out an app and rely on the existing data that they have and the technology that's already in their vehicles to allow their users to rent their Teslas and use full self-drive technology to send it to the destination, pick somebody up, drop them off, and drive home, right?
Yeah.
That is the kind of technological development that is made right. It immediately makes them competitive with somebody like Uber or Lyft. In fact, it probably eats Uber's lunch, right? If my option is to have a driver or have a Tesla and I'm comfortable in an autonomous vehicle, I'm going to take the Tesla. People are already taking Waymos around Phoenix where there's no driver.
I've heard about
And
this Waymo thing, and it sounds super creepy. I have not seen one in Vermont, but yeah,
I think they're in Phoenix. I think they're in San Fran too. I have not taken one.
LA. You're in LA.
I don't hang out downtown. Like they have specific zones and they haven't been useful for me. But like the pie in the sky stuff where they can win is like would be a huge difference maker for them.
Yeah.
Uh, I just that was in the back of my head. I wanted to get that out.
Okay. Well, thanks everyone for joining us today. Episode 101. I think actually no, excuse me, it's 102.
102.
So we're
It's
well on our
102 if you don't count the ones that we burnt before we did the first episode.
right. Yeah, we've probably done like 110. But well on our way to 200. We will be back here again next week and have a great weekend and we will see you then.